Hello guys, welcome to Traders Therapy Session. I'm your host KRO. Guys, in today's video, I will share with you the algorithmic run for Monday's trading, and that will be a follow-up to the video I've just posted there for a weekly review. So without wasting any time, guys, let's just get into it. This is our week market price delivery: Monday, Tuesday, Wednesday, Thursday, and Friday. So I will only focus on Monday. Tuesday is beautiful as well. Wednesday, Thursday, and Friday, they are all good. Everything, the price did everything that we expected. So it will take time, and most of you won't have that concentration span to go through each and every day's trade. You will even forget what has been explained or shared before the previous days by the time we finish on Friday. So I will just, every week I will just have to pick 1 or 2 days. This is good, it's beautiful as well, but we'll just have to randomly pick a day so that we can see how we can attack the market on the daily basis. So let's focus on this daily time frame right here. What is it that we were looking for? Remember the time we recorded the time we took the first screenshots with our analysis on Monday, this was not taken out yet. Let's focus on that. I mean the weekly sell side liquidity. This was our first draw on liquidity. Then, like I annotated on the previous video, then after the weekly was taken out, I will then focus on this one right here, which was the monthly sell side liquidity. After again that was taken out as well, I was going to watch what? The consequent encouragement on a weekly time frame. That consequent encouragement, watch the previous video, guys. It's not that long. It also happened to be the mean threshold of this right order block here when we get to the daily time frame on a weekly. So that is a confluency. So let's focus on this one. I want all of you guys to put your focus here. I know this happened, but let's put our focus here and see how we could have attacked this low right here. So let's go to the lower time frame and see the sessions. 1 hour time frame. Remember that line I was referring to? Some of you might be struggling with time frame correlations. This line right here, it's our main focus. And the price opened here, right above, if you can look at this. The price opened here. This is an open, this is a high, and this is a close. So the new price, daily price opened here, right above what? It opened right above this weekly sell side liquidity. I just want you to focus on that. Look at this vertical line right here. This is our midnight open. This is when the price opened. The price opened a little bit above this, and this was our first weekly objectives. So as price opened here, then we have a London session. London session did the most. London session was able to take out the first objective. Then we have a New York session right here, taking out the London low. You know, everything, guys, it's about the liquidity. Where are the stops? We take liquidity, we take the stops, then we run. So this was London low, previous session low. Remember the framework and the one that ICT shared when he shared the silver bullet. Remember the frameworks. So after taking this, our main point was to our aim was to get to this highs right here, which will be the London high after the midnight open. So we took the lows, then the price pulled higher. But if you can look closely here, look at this. The price did not take this high right here, and there was a reason for that. Then we had a PM session, and then PM session did take the high right there. So guys, looking at this price, you might be frustrated, say, how am I going to get this? The main important thing that you need to keep in mind when coming to this kind of markets, look at the draw on liquidity. That's where you are going to go to. Sometimes, and what I saw with myself, I would see a draw on liquidity, like I would see this level right here. I would want to wait for price to get here, then try to get my entries, and only to find out this thing is you just have to apply a reverse psychology here. When you see this being draw on liquidity, focus on time, and this should be your target, not your entry. If you see this as a draw on liquidity, look at it as your target rather than your entry, because your entry will be easy. If you are on if the time is right, then obviously the price will be drawn to that level. I hope that made sense, guys. Like I struggled with that. I would see price where it's going, but whenever I come into the market, I would maybe sometimes fail. Like you see this one right here, I would want to go for sales, and only to find out that this is done. I could have caught it wherever the price is. Like guys, this doesn't matter where you enter, it doesn't matter. Wherever the price is at the right time, if you have your draw on liquidity right at that point, you just look for any model that you can utilize, you get your entry. But the most important thing is, after you got that entry, where is the price going? You need to hold that. The price is going to this area right here. So whatever is happening here, it will be determined by any model that I will find, as long as I know where the price is going. Same applies here. After taking the liquidity, where should we go? We took the London low. What is the next area of liquidity? It could be this low because it's our second target, or the London high. Then we took the low, then the price went after London high with a PM session. Let's see the entries, guys. Let's see the entries. But this was a London entry. Let's get to 15 minutes time frame. Midnight open, draw on liquidity. Now we're going to see more. We're going to see like anatomy of price. We're going to see more into price, and I'm not going to go to lower time frame 1 minute and the stuff. I'm just showing you the framework and how the price worked. Not that we took the trade, no, the algorithmic run. This is the purpose of the video, to clarify to some people out there, some traders out there who might have challenges knowing why, not knowing why did the price did what it did. So let's just focus here. We're not saying that we took these trades. We are saying we analyze. We're just reading the algorithm, because all of this is just an algorithmic run. You can see, guys. Oh, let me just talk about this a little bit, because this is where everyone is going to understand what I'm talking about, especially the things that I mentioned on the previous videos. Right here on Friday, I guess after lunch, PM session, we had a nice breaker. If you take it from here, from this high to this higher high, and then market structure shift right there, we revisited the premium because we are selling. So we have a premium, fair value gap right here. Then the market did what? Let's try to focus here, guys. I need all your attention here because I will explain some of the things that I've explained before when we get here. We have a high here, we have a high here. Right? High, low, high. So we have a displacement here, which we have a market structure shift right here. Then the market went back. Or you can treat this as a mitigation. You have a high, you have this high failing to get that high. Either way, you are going to get it. Then you utilize that mitigation block. Then you go down. But let's just focus on price. Then we have a breaker right here. You can utilize your OTE, optimal trading entry right here, trade entry right here. You can utilize your breaker right here. That's a model. You see, as long as you know where you are going, where is the drawn liquidity? That's your drawn liquidity. So you have your mitigation right here if the timing is correct. And you have a fair value gap. So this low, this is where second-hand fair value gap comes in. This low right here was taken out by this candle right here. So to me, price performed its duty. Whenever I see the second hand, whenever I see the price coming back to this area, to me it's a second hand relative to this low right here because it was taken out here. But we have something else. We have a new fair value gap right here. The price can come here and take this low while driving towards, gravitating towards this low right here. Then Asian session, price consolidated. During London session, price opened. During London session, we created the high. We are utilizing this fair value gap. We have a little bit of a mohawk here. The one that allows us, even without that mohawk, it allows us, then we give it a second test. This is the reason why I say the second hands, sometimes they are good, sometimes they are just second hands. Then, but because of this new fair value gap right here, you can see the red line, this CB high, CB low. We have tested it here, but it was not the right time. Is the reason why we didn't take this low, because this low is responsible for this fair value gap right here. So it didn't perform the whole night until London session. Then London session, that's when we saw this thing happening. And then look at the time. If the time is right, you just look at any other model that you can see, you can find. But the most important thing was what? The draw on liquidity. And here are the place, the magnetic area. We have a previous daily low, which is the first area, first important area that you could look for. Then we have that area, that weekly sell side liquidity right here. Then let's go to the New York session. The focus here, guys, it's on London session, please. And you can rewind this. You can restart this video and get the timestamps right there and watch each session separately. Then let's go to New York session. What happened during New York session? We have a London low. After London, we consolidated. So we have a London low taken out. What is the draw on liquidity? 1, 2. You can say maybe 3 or 4. Then it came back. We'll talk about this on a lower time frame. Look at this. This was not taken out here for a reason. Then it came back. PM session did the most to take it out. Let's go to the lower time frame and we're going to focus now. We're going to focus on these two entries with more annotations. This was the London low. This London low right here. London low around 8 something here, 9:30 Judah swing. Look at that, 9:30 Judah swing, opposite direction, right? Then to take this low right here. I wouldn't consider this as a liquidity sweep. I would consider this being the right one because the futures market, even though we are trading indices, we are not trading futures, but we are trading cash indices, I mean to say, but the market did not open during this time. So this is just a false run for me. Then this, it's a liquidity run for me because 930. So we have that Judas swing right here. And then we have a displacement. After the displacement, first 30 minutes, you need to watch where the market, what the market is giving you, because it's likely to be a false run though. Then we have a displacement. Do we have a fair value gap? We have one right here. We have one right here. After the displacement, this was 10.25 right here. You could have got your entry here. Where's your stop loss? Below the mean threshold of this order block, or below the candles, or below the consequent encouragement of this. You see now you are protecting your stops now. This would be the last one, or maybe the low here, but this would be the last one. So if the price can break 3 PDRAs, like ICT is explaining, then it's likely it's likely to go against you, by the way, and your stop will protect you for that. So I like to have my 3 PDRAs being before I do what, to place my stop loss below or above my 3 PDRAs, so that I can know that my stops is protected. So I would most likely go below this area, and my stop loss will be around 30 pips if I'm using this time frame right here and this price. And remember that I will be targeting this area, which is 100 and something pips. So 1 is 2, 3, I would cash here. Remember, it's not about the money side now. It's about you reading the price, and it is about the risk management. So around 11 a.m. here, this candle right here, we have a second test. It gave another opportunity to come in. And if you take your Fibonacci tool, this low to this high, from this low to this high, you will get this being a 60. This hard green line here. This other block, the body that was tested, is what? It's 62%, which is an OTE. So is the timing right? Is the timing correct? Yes. Did we take the sell side liquidity? Yes. Did we take the buy side liquidity? That being our drawn liquidity, the London high? No. So you look at your model here. When do you look at your model? Right around this time, after this happened, because we are in a New York session. Because if you focus here, you will be fooled. You could have entered here. You see, the liquidity was taken right here. Let us all pay attention here and see the price that you are going to pay for not being disciplined and not following the rules. This is a good study right here. We see the low being taken out right here. The low being taken out. Look at the time, before 9:30. You have a fair value gap. You might utilize that. You might go to the lower time frame right here and see the market structure shift. Going for this liquidity, that liquidity. Entry fair value gap, below the fair value gap, below the mean threshold, then it would be taken out. Why? If you have that experience, now you have your answer. You got in at the wrong time. So you need to wait. Judas swing to occur. And I'm in South Africa, guys. 9:30 for us, it will be 15:30 afternoon time. So after this, after 30 minutes, then that's when price comes here, after you've seen this happening, you can start to look at your model here. What model did you use here? Accumulation, manipulation, distribution. I know most of you would interpret this as a wipe off. I just realized it right now that I have the spring liquidity sweeps and the likes and the test and all of that, but we are not doing that here, guys. We are just reading price for what it is. Then the model just come out. After the displacement, you have a fair value gap, you have an order block, you have a criteria to go in. Plus, you took out the liquidity. Then you have a first entry below, then it's pull. You just got to be to enjoy this drawdown. And then after that, the price ran. Price went for buy side. You need to take something out of here. You need to take something out here. Because after price has taken out this low, price has delivered. Then right around, and you could have been out because even after this, you have fair value gaps here. Most of your positions could have been out here. Then after during lunch, we have a consolidation. Stop loss run, consolidation, accumulation again, manipulation, distribution. Let's look at this. What do we have here? What do we have here? Guys, let's talk about the second hand right now. The second hand fair value gap. We have this right here. Price went into it here. I'm not sure, or we can use this one right here. I didn't check the price here, but we can utilize this. It's still fine. It's still okay. It does the same thing. Price went into this fair value gap. What is the high that is responsible for this fair value gap? This high right here. Pam. It was taken out. For me, price has delivered, has done its duty. It came for the second time. Like I mentioned, guys, if you are watching the previous 3 recent videos, you would see me talking about this. When it comes back, I give everything. Like, I don't look at this to perform to its area. I also look at this to be violated. I also expect this to be violated. So it occurred. Second hand, it should take this high, going to this high, but it failed. It met with this right here, and I guess it's 130 trade. Then you have your breaker right here, displacement, OTE, as easy as that. First, second fair value gap, then the market went. This is the low that is responsible for this fair value gap, and it needs to be taken out. Where? Right here. You could have got this entry cell, but let's focus on the second hand fair value gap. Guys, this is so amazing. It's the reason why I say I cannot even talk about 5 days here. Let's just focus on 1 day. Maybe I will do per week. Maybe we'll do 2 days or 1. It's enough, guys. You will do it on your own as well, so that you can exercise yourself. Remember that you are gaining experience. Your mind doesn't know whether you've traded this or not. So whenever you are doing it, repeating it, it just gets into your mind as it gets to be stored on its own shelf. So whenever this happens, you get to, what is this? You get to see, it gets to be easy. Let me just say that. You will get to see it. It will unfold to you, if that's the correct way to put it. This is the reason why I said second-hand fair value gap sometimes are good. like the one that we saw here, the second-hand fair value gap, performed. Sometimes they are as good as second-hand. We expect the price to go high here, but what did it do? Invaded. So we have invasion fair value gap right here. But for a reason though, we couldn't take out this liquidity. We missed the target for a reason. CPM session. We have inefficiency here, a busy here. We have a displacement. We have an order block right here. This low to this high, somewhere right here, it's 50%. We have a fair value gap right here, it's on premium. Remember, we are buying. We buy at the discounted area, we sell at the premium area. So right below here, it's a premium fair value gap. It's a discounted, discounted fair value gap. You have your order block. You have a reason to run for this liquidity. You cannot leave price like this. Technical traders will see this as a resistance. Technical traders will see this as a double top. But you have to see this as money. And time, it's very important, guys. Look at this. Last hour of trading, 15:10. There's your entry. There's your second entry if you missed it. What is the reason? Why do you enter here? Why do you want to enter here? Because you want to run for that liquidity. Like, guys, grab your notepad if you are watching this. I just want to give you, to some of you, it will be a breakthrough, not financial breakthrough, but I want to clear your confusion right here. I just want to clear your confusion once and for all. There are 3 steps to follow. Just 3 simple steps to follow on reading price. Step number 1, of which is an important step than any other. Step number 1, and they value, they hold the way they've been put. How do I put this? Their importance comes, the importance of the steps, they come as prioritized as, let me just say, the way that I've put this, please keep it this way. The first one is most important. The second one is most important, but the first one. Then the third one, it's important, but without the first one or the second one, the third one doesn't do anything. But the first and the second, they just go together. They just happen to go together. So the first one is, before you can even go to pull a trigger or to do anything, you must think about first step that I'm going to tell you. Then the second one, then the third one. First, second, and third. That's how their importance goes. The first thing to go to look for when you open the chart, ICT stressed it, and I also stress it, because I would understand the patterns. I would go for the pattern or for the model and enter. Sometimes I lose and I don't understand. It's because of this thing. Before you can even look for any other model, any other entry trigger or anything, look for liquidity, draw on liquidity. Like everything else, let it be based on that point. Look for draw on liquidity. That will be number 1 on your paper. Draw on liquidity is the most important one. And like my former mentor used to say, if you cannot see the liquidity, that means you are the liquidity. So the first thing first, see the liquidity. If you see the draw on liquidity, then you can start to look at other things. But first thing first, draw on liquidity. That's number one. I cannot emphasize this even more than this. Draw on liquidity is your number one. Number two, the time that you are getting into the market, the time that you are participating. That's very, 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 very important. That's very important. Guys, we've seen this. This is not the right time. This is the right time. And what do we know about this time? This is Judas swing. Understanding price and time. Guys, like, draw on liquidity. That's number one. Where is the market likely to draw to? This is the area. The time, last hour. Are we done here? No, we are not. Everything else, then the last step. 1, draw on liquidity. 2, time. 3, that's when you can start to shine. Think of your OTEs, think of your breakers, think of everything else. But if you don't do that, that will cause frustrations, that will prolong your learning, that will do that. That's what I found. That's what I saw myself doing. So let me just save you. And if you don't believe me, just do it your way. Because what I found is that most of the traders, and especially when we come in here, what we do with this kind of a way of analyzing market is that we prioritize these steps backward. We start to look at the pattern. We start to look at the model pattern, whatsoever you can call. After that, that's when even time sometimes is not considered. After, then we wonder where we can take our profit. Where we can take our profit. Guys, that's the wrong way. If you were doing that, stop. You are hurting yourself. Do this the right way. Look for liquidity first. Number 2, that's when you consider time. Look for liquidity, consider the time. After, be in the market at the right time, then see if the market is giving you what? See if the market is giving you the model to go to that liquidity. Because sometimes, like, you would read market like, if you are focusing on the pattern or that model, you would see, I would say, price going down. Maybe let's say, for an example, you would see this liquidity right here, 1, 2, because you didn't consider the liquidity before you come in. Just because you are seeing this right here, this fair value gap right here, you would want to come in. But we're done with this. Consider the area of liquidity. Where is the price likely to go? At this point, it came in the form of a single high right here. Some of you won't understand what I mean by that, but as time goes, you will. I promise you, as you read price and everything, you will. Because relative equal highs were taken here. Then this is a liquidity. This type of a liquidity is a single high, and they need to be an excuse. Then what is an excuse? We have these inefficiencies right here. For market to do what? For market to drop down. So we have everything to go out of the market right here. But the point, we are targeting this. So guys, without wasting any time, we got into this inefficiency, the discounted area. Then we ran finally. And look at the candle that took the liquidity, the last hour. Look at that. Nice, beautiful. 16 hour. Guys, without wasting any time, I hope to make videos like this, more of them, so that you can get clarities on what the market did on a certain day. And please bear with me as we do more and more of these videos. I hope I will find a way of which I will keep them short, precise, and straight to the point, as well as trying to look at the gaps. If I didn't meet your expectations on this video, please forgive me. I'm trying, by the way. I'm trying to be able to reach a lot of you out there. Like I mentioned, I'm not better than ICT. I'm just trying to share with you the things that are happening in this market, in this kind of market. And then once you get the understanding of the market, you will see things clearly. And once you do that, it's up to you on what you do with the knowledge that you gather here. We are only sharing this for a knowledge purpose. We are not encouraging anyone to trade using their funds. If you wish to trade with us, you can use the trading view paper trade, of which you will be participating on the live market, but you will not be losing any money. You will not be gaining any money, by the way. You will gain experience on this one. Okay guys, thank you. See you on the next video.